Most of the conversations on this show start from the data side of the table. Somebody built the sensor, somebody moved the data, somebody tried to sell it into a carrier and watched it die. Somewhere between the demo, everybody nodded at the procurement process that never ended. Today, we're doing it from the other end of the table, from the side that priced the risk, raised the capital against it, and now sits on the board that decides whether any of it gets adopted. I'm Kevin Henderson. This is Structural Signal. This show is about the operating layer, the messy middle where data, technology, and capital meet actual organizations run by actual humans. It's where most good ideas go to die, and the people who kill them are usually being perfectly rational about it. My guest today is Susan Holliday. Susan spent her career at Swiss Re, where she ran reinsurance strategy and led investor relations, and where she was part of restructuring the company so that each division carried its own P&L and its own balance sheet. She went on to the International Finance Corporation, the private sector arm of the World Bank, where she led their first insurtech investments and worked on building insurance markets where the historical data simply didn't exist. She sits on the board of Hippo and PensionBee. She's a non-resident scholar at the Insurance Information Institute. She spent more than 30 years doing this across developed and emerging markets. I've spent years finding markets for telematics data. Susan has spent years on the other side of that transaction. And a lot of you listening are trying to get something into a carrier right now and cannot see inside the building. The demo went well, everybody nodded, nothing has happened since. Today we're asking somebody who spent her career in that building. Susan, welcome to Structural Signal.
Thank you, Kevin. I'm happy to be here. Good to see you.
Somebody leaves a big carrier tomorrow and wants to start something. Walk me through why the answer is almost always MGA and what would have to be true for it to be anything else.
Sure, great question. And it's kind of happening more and more now. So I think there are a couple of reasons. First of all, lots of people, probably including us at certain points in our careers, get frustrated with working for big companies, right? And, feel more entrepreneurial and so on. And the other thing is you get people who are in either a very niche area or a kind of cutting edge area that is maybe not big enough to get much attention in the carrier, or they think it's too risky because it's something new. And that's when, an MGA is probably a good idea. And so typically you get a group of people that kind of like know each other, who've maybe worked together, coming from carriers, sometimes brokers and so on. And they kind of think, we can focus on this area and we can do it better on our own. Of course, it only makes sense if they actually, are good at underwriting and can source the business. But the other thing I would say about MGAs, and part of Hippo's business is working with MGAs, is that, in my opinion, there are certain types of business for which MGAs work pretty well, given the caveat I just made, which, as I say, is kind of niche areas, non-standard areas, new types of risks, and we can maybe get into that a bit more later on. Where it doesn't really make any sense is if you've got a commoditized type of business where you haven't got any competitive advantage against the big players, and you maybe have a big head, right? You think you can do it better, but then it's kind of hard. So to me, it has to be a niche area and or a sort of new type of risk, then it can work pretty well. And I think the market has learned some lessons from what went wrong with MGAs in the past. So now, they are viable propositions for carriers to work with.
So what went wrong in the past and what have they learned and what's working now?
So as you mentioned, and you were very nice because you said my career was over 30 years, which is true. It's actually also over 35 years. So I've seen MGAs come in and out of fashion, let's say, and kind of for good reasons. So usually the problems in the past were that effectively the carrier is giving underwriting authority, what we call giving away the pen, to the MGA, right? And what happened in the past was instead of sticking to their niche area that we just talked about, they started underwriting other things. And nobody really noticed. And then the carrier was on the hook for these other things, and there were loads of claims, and didn't end well, right? And often didn't end well for the client, because even though they got paid, the next year no one wants to insure this thing. So it was really a lack of real-time information and a lack of control. And both parties were guilty, right? The people in the MGA, because they were kind of doing stuff they shouldn't be doing, but also the carriers for not monitoring it and kind of keeping it under control. And a lot of companies had really big problems with MGAs, and they became honestly like a swear word. What I think is different now is that, as I say, people have learned the lessons of the past, and also the concept, and this maybe goes a bit to what we're talking about later on actually, but of kind of like data and continuous monitoring and so on is much more realistic, right? You're not waiting for monthly or quarterly bordereau. You're not waiting for pieces of paper. So it's much more feasible. And I actually think people often ask, is the kind of proliferation of MGAs cyclical or structural? And maybe it's a bit of both, but I actually think it is structural because there are more areas now that are becoming more technical, more complicated. You really need a particular type of expertise. And there are new types of risks that need to be insured that a lot of the mainstream companies have been kind of either scared of or didn't want to allocate the time to. So we saw it with cyber, which is now becoming much more mainstream. We saw it with crypto, where for regulatory reasons, a lot of companies were kind of nervous about doing anything. But the fact is there are crypto businesses out there, they need to have insurance. And now I think we're also starting to see it with AI, because you're seeing some kind of new companies spring up which are very, very focused on AI and need a particular type of expertise to really understand the risks. So I actually think, for the ones who do it sensibly and who have the right partners, that, it's a good time to be an MGA and it makes sense to be an MGA, but that doesn't mean that it makes sense to be an MGA for, personal motor, for example.
So you had mentioned, it's a very good point. So you had mentioned on the MGA, and especially new risk or they need specialized. So for the challenge for the larger carrier, is it a data problem that they can't interpret data, they can't ingest the data? Is it a systems problem? Is it an attention problem? Is it a personnel problem?
So I think it depends on whether we're talking about niches that are not new or we're talking about new risks, right? For new risks, it is actually a data problem for everybody because there's not much data because it's new, right? So then it goes a bit to risk appetite and how much effort are you prepared to put into this, and is there alternative data kind of out there that you can use? With the more established types of business, I mean, the classic MGA was always yachts, right? I don't know anything about yachts. I'm not a sailing person, but it was all about yachts. It was just that the amount of premiums that insure yachts is not enough for a big carrier to really care about, right? And they don't want to have lots of people looking at this and the systems and trying to understand it. And it's like, this is a small part of our business. Let's go away and let's do property and, motor or whatever it is they're doing. So I think in the first, with the older risks, there is data. It's whether they can kind of be bothered to do anything about it. With some of the newer risks, one of the challenges, but not only for, the big incumbents, but also for MGAs, right, is there isn't very much data. And it's also changing because if you think about something like AI, right, it's changing so quickly that even if you have data, first of all, it won't go back very far, but even if it goes back a couple of years, it's probably all wrong now. So then it becomes a challenge, where to focus, how to become predictive, not just looking backwards at data that's either not there or maybe not relevant anymore.
So let's go more into AI. So what are the issues that you see with AI that carriers are getting wrong and they need MGAs for?
So my thesis, which may be wrong, right, is that AI will go a bit the way that cyber did. So if you think back a few years, maybe like more than a decade now, cyber was kind of silently included in all sorts of policies, right? And people didn't really think it was a big risk and it was all fine until the claims started coming. And the first thing that carriers tend to do when they suddenly get a lot of claims they weren't expecting is exclude things from the policy. So then you've got a bit of a problem because there's this risk out there and now it's excluded. So guess what? MGAs and specialists kind of set up, right? Because it's like, well, someone needs to focus on this. We know about it. It needs to be insured. Then usually over time, some of the more traditional carriers, there is more data and they become a bit more comfortable with the risk. So maybe they do start underwriting it again, either kind of putting it back or putting it as a rider on existing policies or as a separate line of business, but more kind of mainstream. And also the companies start to understand how to kind of assess the potential insureds, right? So you can't get, or in most cases, you can't get cyber insurance without having certain standards in place, filling out questionnaires and all this kind of stuff, and maybe being interviewed by the broker or the company. And if you lie on the forms, then the policy is invalid. So they've worked out a kind of like, okay, there needs to be a certain health check before we're going to give somebody cyber insurance, right? One of the challenges so I think AI is going to go the same way. At the moment, AI is included in lots of policies. Pretty soon, this is going to start going wrong, and I think it's going to be excluded or partially excluded. And there are some specialist companies and MGAs being set up now, particularly focused on AI. At the end of the day, AI is so big that it's going to have to be part of things like E&O and D&O and cyber and so on. But the carriers need to understand what they're underwriting. And with AI, I think we're still, and actually this links with cyber, we're still at the point of like, okay, what do we need to know to be satisfied that they're really managing the risk? And the cyber risk obviously has changed because of AI, because of mythos and all these kind of things, right? It's much easier to exploit any deficiencies in the system. And with AI itself, it's changing so quickly that, you can have a checklist of how to be good at managing AI, but it might be kind of wrong 2 weeks later. So I think this is a genuine challenge for the market, for MGAs working in this space, and for the companies providing capacity, and for the more traditional insurers. But, it makes it interesting, right?
Now, you had mentioned that as the carriers get more data and they become more comfortable, they start writing these policies themselves. So does that mean that the MGAs are R&D for them?
Well, so it depends who the MGAs are working with, right? So in many cases, the MGAs are working with companies that focus on providing capacity with MGAs and not with all the big carriers. There is a bit of that, but it's also not that easy to replicate the expertise. So I think it goes a bit to one of my favorite topics, right, about risk appetite. If you're leaving a company to set up an MGA, you have a certain risk appetite for your own personal career as well as for the risks you're underwriting. Some of the traditional carriers, they might be more nervous about something with less data and so on. And then for the capacity providers, if that's the right word, with the MGAs, they have to decide. I mean, they like track records too, right? They do vetting and analysis on the MGAs. But in some cases, with some of these new risks, there is no track record. So you really have to go on the people and what they've done before and so on. And one of the challenges for these companies is, you don't want to bet the farm on some new team writing some new risk, right? So the companies who are supporting MGAs want to proceed carefully, don't want to retain too much of the risk of some of these new things, and want them to kind of build up a a track record. Having said that, if the MGA is successful and the results are good, then the capital provider will be happy. Then if the bigger carriers want to get back into this line of business, then there's a bit of a kind of like war for talent, right? Because if the folks are happy in the MGA and they're doing well, maybe they want to stay in the MGA and they don't want to go and work for a big carrier again. So it gets kind of interesting.
So what are you seeing? What are the trends? I mean, how are carriers doing pulling people out? I mean, out of MGAs?
Well, I don't have any proper data on this. My gut reaction is two things, right? One is I know a lot of people who've left big companies to do startups, and it's not that easy to do a startup. So they realize that it's not that easy, that, certain aspects are kind of a pain in the neck, and they want to get a job again at a big insurance company or a broker or whatever. And maybe that company or broker is like, okay, yes, we need expertise in this space, kind of welcome back. The other thing, of course, that can happen is M&A. So it is not unheard of for insurance companies to buy MGAs. And that's kind of another way that maybe you end up in a bigger kind of ecosystem. So those are the two kind of things that I'm really most familiar with.
So let's say you're an MGA and you're doing well and you're starting to think you want to hold the risk. What's the pull towards full stack, and how often would that be the right instinct?
So it's a very, as the English say, very different kettle of fish. I don't really know why we say that, because I don't think fish should be in a kettle. But anyway, so the question is partly, where do the economics lie, right? And this is actually interesting because, as some of the listeners will know, Hippo is earlier in its life was an MGA, and it also owns a carrier that provides capital for MGAs, both in terms of fronting, so where basically they're providing the paper, but then most of the risk goes off to other players in the market, but also retains material amounts of the risk for different programs, right? And so if you have your own balance sheet, you do, I guess you can control, you're kind of vertically integrated, right? In a sense, you control more of the economics for good or ill. And like, that you've got capacity, right? Because if you're an MGA and, you're working with a carrier and they just go, oh, we don't have enough capital, or we don't want to do this type of business anymore, that can be a problem. However, it is much more complicated to run an insurance company than to run an MGA, because MGA is about getting the business, and yes, okay, it's about underwriting expertise. In some cases, it's about claims. In other cases, not. That may be done by third parties or by the carrier. If you're talking about being a full stack insurer, there's a lot more regulation. There's a lot more to worry about. Reserving, investment management. If you're doing, longer tail business, you need risk management people. You need complicated. You probably need internal audit. All this kind of stuff. So, and then you end up well, first of all, you could end up back in the position where you were with a bigger company. But the problem is, if you're an MGA and you just decide you want to be a carrier, you have a big disadvantage, because you're a carrier that's just focused on one line of business. And that's very difficult because you're not diversified. So one year, maybe the results are great, but the next year they could be absolutely terrible. And we've seen this a bit with small companies, for example, who just write property insurance in Florida. If it's a really bad year for natural catastrophes, their results are appalling and they're really, really under capital strain. If they get lucky another year, maybe it's really good, but that's not necessarily sustainable. Big insurance companies, and even more, reinsurance companies, right, are very diversified. And so, maybe one line of business is not doing so well, but others are compensating. So in my opinion, to set up a carrier to only do one line of business is like highly risky, and I'm not sure I see the point of it.
So let's stay on that point. You had mentioned about an undiversified carrier's economics. Um, so let's talk about what happens when they need somebody else's balance sheet. Who actually captures the margin?
Yeah. So, I mean, there are a few ways of doing this, right? So they would increase their reinsurance buying if they can, but of course, the reinsurer in this case is calling the shots, right? If they not having good results and they know they're desperate, so the answer in that case is the reinsurer. Another thing that I've seen happening sometimes is that companies in other parts of the ecosystem, if I can put it like that, will sometimes invest in the capital of these companies, but they're getting other business from them. So, for example, some brokers do this, but then they are getting, they're placing business into this carrier, and they also could be placing the reinsurance business out. So they are getting some of the economics back as well as the return they hope to get on the capital. It's also, I mean, it depends how it works out, right? It's not necessarily crazy, because just because you have one bad year doesn't mean that you have another bad year, but it also doesn't mean that that won't happen. So we all know that, you can have two 1 in 100 year events straight after each other. So you are right that in this example, however you solve it, you're going to be giving away the economics to somebody else because you're desperate and they're not, right?
So again, you'd mentioned that, about your experience on Hippo's board. So how does a board actually weigh capital efficiency against control, and what are you watching for?
So, as I say, Hippo has its own homeowners business, and then it owns a company called Spinnaker, which it works with MGAs. So, and one of the thinkings behind that, which is before I was on the board, was for diversification and also to build kind of like greater expertise in the company. Because if you're only writing homeowners, particularly only in certain states, again, that can be very volatile. So they have over time been taking more risk on the balance sheet. So what we are looking for, is the track record and building up expertise in-house, right, on different lines of business, especially the more complicated ones, and also definitely, diversification. So as you go down that road, you do need more expertise in areas like underwriting and claims and so on. And also you need to apply technology basically to managing an insurance portfolio, right? Not just to underwriting one line of business or to kind of just bringing in new business. So at the end of the day, the board members are not running the company. We're kind of exercising oversight. But, we are looking at, okay, what type of areas, how are the results, what type of areas are they looking to go into, how much risk is being retained in different areas, are there areas that we think we can grow in? Hippo has announced several partners where they're working together on certain lines of business, which is kind of a win-win. So, we're also looking at those kind of strategic questions, but board members should not be like in the weeds of, detailed data questions or, detailed underwriting questions.
So let's talk about data in insurance. So insurance has had more data than almost any industry on earth for longer than almost any industry on earth. How would you say the industry has been at using that data?
Mixed, mixed results. So I think there are a few different things, right? You're right. Insurance typically had a lot of data and it didn't necessarily help them. And it was a bit like, I think we talked about this when we were having the prep call. It's like Cheesecake Factory has a very big menu and then you can't decide what you want to eat, right? So I think one of the challenges is there are tons of data, but what to do with it and what's the data that actually matters? we all know from our own experience, if you buy a life insurance policy or something, they ask you loads and loads of questions. When I did it, like a nurse had to come to my house and all this kind of stuff. But the reality is there are like 5 or 6 questions that are actually the ones that matter, right? So one of the challenges is, okay, what's the data that really matters, and kind of what do we do with it? And unfortunately, it's a bit like exclusions in insurance policies, right? It's easy to add them, it's difficult to take them away. So it's very difficult psychologically for companies who are asking people for 10 pages of information to say, okay, we're going to underwrite off 6 things. And that, to go back to the earlier question, is where some MGAs are good, because they're like, our raison d'etre is we're going to underwrite from these 6 things, right? And so that's one problem. The other problem, which we've referred to earlier, is you can have tons of data, but it might not be relevant anymore. So let's take something we all understand, because I don't know about where you are today, but where I live, it's pretty hot outside. It's 100 degrees Fahrenheit. So insurance, one of the areas where they have tons of data, literally going back hundreds of years, is weather data, right? And natural catastrophes, which is awesome. Although it is debatable whether, data from 100 years ago or 50 years ago or even 10 or 20 years ago is actually that relevant anymore. So it can also be like a false sense of security, right? Because you have all this data and you can put it in the model and it can spit something out. But, is all this data from ages ago really relevant? Then the kind of art comes in on, how to make it more predictive, like what you need to tweak. It's almost like when you're building an AI model, right? And if you have an open source and you're changing the weights. So that's where kind of human judgment and experience and the diversified portfolio really needs to come in, because I'm actually quite concerned in certain areas that are very nat cat and weather exposed, that insurers, but also banks who are making lending decisions, are basing them off data that isn't relevant anymore.
So let's talk a little about you said that the record's mixed. So why are they good when they're good, and let's say when they're not so good at it? What's the difference?
Well, okay, so I think you have to be able to see the wood for the trees, right? What's important. Then there's the question of what state is the data in, because financial services companies in general, not only insurers, definitely banks as well, they have a lot of data, but typically it was kind of all over the place, right? It was in different formats. It was different types of files, like handwriting, in different silos, in different departments. They didn't necessarily know. So one of the good things about AI is that you can take unstructured data. I mean, I have really, really bad handwriting. And as an experiment the other day, I loaded some handwritten notes on paper, not even on an iPad, into a large language model and said, like, sorry about the writing, but like pull out the main points from these notes. And it did a pretty good job. And it also queried things it couldn't read, which was quite interesting, because honestly, I could hardly read it. And I wrote it. So that's an area that I think AI can definitely help with. And then so I think where they're good, or where they're good now, is if they are sorting out what data they have, who has it, and getting it kind of into a decent format and kind of consolidated. One of the other problems, which you will know very well, is kind of the data stays in silos, right? So this sounds totally obvious, but there are all sorts of examples in the insurance industry of where the claims folks were not talking to the underwriting folks. So they're seeing all these claims, but they're not telling people like, hey, like, look out for this when you're underwriting. I was actually talking to somebody from a company earlier on this year who, and I was talking to the CISO, to the Chief Information Security Officer, and this company underwrites cyber as well. And I said, are you talking to the underwriting folks and the claims folks who are doing cyber? And they're like, oh no, that's like a really great idea. Which it was, though I say it myself. So that's one of the other problems. To be good, you need to have a continuous loop, right? Between who are making the decisions, and it may even start with like who you're marketing to, what kind of risks are you getting into the funnel, then underwriting and pricing and claims, and it needs to work like that. So when that's happening, then companies are doing much better, and usually I would say have a bit of a competitive advantage because they can react more quickly, and it's based on real data, not just someone's hypothesis.
So we talked about data and what they actually need versus what they don't. What kind of data does an underwriter actually need that they don't have?
So look, this ties in with being a board member as well, right? Because there's a risk when you're a board member, you have to approve the quarterly results and all this kind of thing, that you're always looking backwards. You get something presented to you, like this is what happened last quarter or last month or whatever, like fine. But what about what's going to happen, right? So I think one of the big challenges is and it's different for each line of business, but to try to know like what is predictive. I always think it's funny, and again, let's take an example that everyone can relate to because we've probably all done this. But if you had telematics or your personal motor, because I was not, and I did it because it's an interesting experiment and you get a discount, so what's not to like? And I'm a decent driver, but I wasn't entirely convinced that the things they were monitoring were actually the ones that were really kind of the deciding factor, right? I think it was almost more of a screen. If you're prepared to accept the telematics, you're probably a decent driver. And I've seen articles that suggest that things like, for example, I don't know, so they hate hard braking, right? If you do hard braking, that's bad. Okay. But if a kid runs out in the road, you probably better want to be doing hard braking and not hit them for social reasons as well as your insurance policy, right? And there are things. I mean, I think it's what time of day you drive at, for example, is more likely to be a good indicator of whether you're going to have an accident than if you do a little bit of speeding or hard braking. So I think that's a challenge to know kind of like what are the more predictive data points rather than just gathering data on what happened.
So let's talk about your IFC work. So your IFC work built on underwriting where the historical data didn't exist. In mature markets, the problem is the opposite. There's too much IoT data and not enough that anyone can use. Put those side by side for me. Does the emerging markets version expose something about what data is actually for that the data-rich version hides?
Well, I think there's a challenge. So the interesting thing about emerging markets is that you sometimes have to rely on different sources of data, right? However, where that becomes a bit complicated is there are all sorts of data protection laws around in different countries, right? As you know, I'm originally from the UK and they have GDPR and it's kind of pretty strict. So there's no doubt, for example, that insurance companies could probably price policies better if they could look at all your social media, but people would not necessarily be very keen on that, right? So sometimes in emerging markets, there are less rules, so you can experiment with things. But on the other hand, people are people. So even if it's not against the law, there are things that companies may or may not want to do. And as I say, if it's very off-putting, then nobody is going to buy the insurance. So what I think has been useful, and this is becoming more mainstream now, but is things like geolocation. I mean, like Google Earth is everywhere, right? And just to take a very simple example, in lots of countries that I've done business in, you don't really have an address, right? It's not like you have a number and then a road or whatever. And people just know where it is because it's like, 5 doors down from the shop or something. And traditionally, that kind of thing has been a real problem for insurance companies. They're like, well, we don't even know the address. But you know, you can use like geolocation data to kind of like understand where it is. You can also use data from people who are going there, maybe like making deliveries, this type of stuff, right, to kind of like know what's going on. So there definitely are ways around it, but it's a challenge. I don't know if it's so much data that's a challenge in emerging markets. I think it's the kind of loss history, right? Because if people didn't have insurance, you don't know what's going to happen. And there was an interesting example. This wasn't really about claims. It was more about the popularity of the policy. But a company that I worked with, and I was at IFC, who was trying to develop insurance policies for women. They had a great idea of having, some kind of coverage for maternity if the woman was having a baby. It sounds like a great idea, but it wasn't actually that successful because, first of all, only companies where there were loads and loads of women wants to buy the policies, right? So there was like anti-selection, and it also and then it upset some other companies. Are like, why are we paying all these premiums when no one's going to have a baby in our company? And so I thought it sounded like a great idea, but it wasn't actually commercially very viable.
So you had mentioned one of the other challenges is the lack of loss history. Does that make them better at predictive analytics?
So it should, but I'm not sure it does. So the problem is there are not a lot of actually really cool MGAs in emerging markets, right? And part of the reason is because somebody has to actually underwrite the thing. So a lot of the companies that do business in emerging markets are either big international companies or they're, traditional local companies that have been around for quite a long time. And this is a bit of a sweeping statement, but in many cases, their technology isn't very good and their data isn't very good. So and therefore they're not the best people to do kind of like great predictive analytics. I am seeing a few things that are interesting, for example, in the crop insurance space, using geolocation data, weather, et cetera, and where they can also work with the farmers to identify issues. And this gets into the kind of preventative part, right? Work with farmers where there are issues, say with, you've planted a crop, it's not growing properly, or there's like drought, too much rain, this, that, to take action before the crop fails and do something else. And this has actually also increased the yields for the farmers quite a bit. So it's a win-win. Now, the farmers have to, go on an app and do things, and, it's not totally seamless. But some of those examples I think are good because it's kind of, it's preventing things going wrong before they've totally gone wrong. And it's actually helping people, right, have a more sustainable livelihood, because if the crops failed, even if you get some money from the insurer, you've probably got other problems at that point.
So in markets where there are fewer rules about what you can do with people's data, does that make it easier?
Yes and no, because people have to be kind of comfortable with it. And it is a risk, right? I mean, I looked at a potential investment when I worked for IFC, and I won't, for obvious reasons, go into details about it, but they were basically doing data gathering. It was kind of like, it was supposed to be insurance, but it was kind of data gathering, which they were then selling to all sorts of different companies. And I wasn't comfortable with this at all. And I said, we should absolutely not do this investment. And we didn't. But I think there are, there are issues because regulations can come. You can upset the customers, reputational risk, all sorts of stuff, right? Just because something's legal doesn't mean that it's a good idea.
Yes. So let's talk some more then about what actually happens with the data and how it gets turned into a product. So let's say you're a founder and you have data that a carrier needs. You're convinced that everyone likes the demo. They nod their heads, and then nothing happens for a year. So explain what's happening inside the building during that period.
Okay, well, this is a bit depressing, right? This question. Um, I think there are a few things just based on what I've seen over a large number of years. One which I referred to earlier is, how big is this line of business in the company, right? Because if it's very small and not that important, unfortunately, it's going to get pushed to the bottom of the pile. Okay, this is really cool, but like, so what? Because we make 60% of our profits from something else, right? That's one thing. Second thing that makes a huge difference is kind of having a champion at a senior level. Um, Unfortunately, a lot of things get kind of put on the back burner because no one's pushing it. And often no one's pushing it because it's not part of their job to push it, or they may even see it as a threat to their job to push it. And the other thing that I know we've talked about before, which can happen, so you get all excited because somebody senior in the executive committee or whatever, goes to the demo and really likes it. And then it disappears into the morass of what I think we referred to earlier as the messy middle, right? Where, again, may not be a priority. People might think it's a threat to their job. They've got other things to do. Maybe they don't really understand it and they don't want to say. So it is a bit of a lucky dip. And to me, for these things to be successful, you need a kind of champion who's senior, and you need to be able to really demonstrate kind of ROI to the company. So not just that, okay, this is cool technology, it's interesting, whatever, but okay, this can reduce the loss ratio by such and such a percent or whatever, right? Something really granular like that, because otherwise you're right, people go to a demo and they think it's cool, but then nothing happens.
So how much of that is this process? How much of that is the company using proper due diligence, and how much of it is just that they're resistant to change?
I think it's both, depending on the company. So, I mean, companies, and look, as a board member, I don't want the companies to be totally distracted by every new and shiny thing, right? So sometimes, even from the very top, we're kind of saying, look, let's focus on the kind of material stuff. A lot of companies have long procurement processes, which I honestly think is annoying, because it would be better for everyone to make a decision more quickly. So I think long is bad. However, I think thorough is good. And why? Because there's a new huge risk now, which is related to like cyber and AI, right? Again, wearing a board director hat, I'm always asking a lot of questions about like, how are we vetting third parties? Because if it goes wrong, you can have all sorts of problems that are not to do with whether they have good data or they're good at underwriting or whatever it is, but as I say, to do with like compliance issues, cyber issues, all sorts of things. So I think thorough vetting is good, but to me, I think the process is often too long. And part of the problem in very big companies is the people who are responsible for procurement are nothing to do with the business, right? So their job is to run this process and, at a leisurely pace. They are not the person who's waiting like, oh, I really, really need to, to kind of work with this startup or work with this MGA or whatever. And, ideally, right, you would want the business to be more integrated. As an example, in Hippo, the technology folks are very, very integrated with the business, but that's not always the case in big companies. And when you get into like governmental NGOs, governmental type institutions, they have a lot of rules, not wrongly, but my experience is that procurement processes can be very long and painful. And by the way, it's not only procurement processes, it's like hiring and all sorts of things.
Yes. So you had mentioned, so let's talk some more about AI. So you had mentioned, and also middle management. So you'd mentioned, when AI. So when AI comes up in a board meeting, who is pushing? Is it the board? Is it management?
Well, interestingly enough, this is not proper data, right? But based on my experience, as you know, I go to a lot of board director conferences and other events. Um, Interestingly enough, my perception on AI is that in most cases, the boards are like, yeah, this is a great opportunity. We want to deploy AI, obviously, in a responsible way, um, perhaps more than the management. Now, board members are supposed to be strategic, sit at a higher level, and all the rest of it. But we also don't need to deal with the kind of day-to-day, hassles, right? So I think different from some other things. For me, I see more kind of like appetite with AI at the board. I think a lot of C-suite are really keen on it. Um, to me, where it can run into problems is kind of like in the middle, which is not a surprise because we saw this with, in the insurance industry, there was a big thing about digital transformation, right? And where it often went wrong was kind of not at the board or the exco, but when you actually had to implement it, and it was kind of middle management. And I think for a number of different reasons. First of all, look, they're at the coalface, right? And it's easy to say, oh, let's do this, but it's harder to actually do it. I think also, though, there is a bit of defensiveness, and especially about AI, because there's a lot of narrative in the press that this is going to, take away jobs and so on. And I think that's, not untrue. I'm lucky because I serve on the board of two companies which are growing and are tech native. So we're not in a position where they're going to lay off lots of people because of AI, because maybe we're going to hire less people for the growth, but and people are adaptable to AI because of the types of companies. But I think part of it is people are worried about their jobs. They don't really understand it. I've seen a lot of statistics of when people actually start to use AI, they become more positive on it. When they haven't used it, it's like, whoa, this is totally like a black box. It's going to take my job. It's going to make all sorts of mistakes. I'm going to get into trouble. And that doesn't mean that AI doesn't make mistakes and have bad things about it. But when people, start to use it, and what it's good at, what it's not good at, they usually become more favorable. Interestingly enough, there are two different schools of thoughts about kind of like hiring young people and junior people. So some companies are saying they're going to do that much less because AI can do a lot of the tasks. I find that a bit concerning because where is the CEO in 25 years' time, right? I know some other companies who are actually still hiring, graduates and so on, because they're kind of AI native, right, and very adaptable. They've already been using it in college, and for them the problem is, as I say, the middle management layer. However, I would caution on middle management because these people have a lot of like institutional knowledge and experience. And, we've seen this, as I say, with digital transformation, with, crises like the financial crisis and other stuff, where you suddenly maybe lose a lot of those people. And, guess what? Someone who's been in the company or in the industry for 20 years, that they know a lot. And it's actually, ideally, it's these folks who need to be using AI and trading AI and seeing where it's good and where it's not good, and really capturing all the processes so that you can then deploy AI. If you lose their expertise and you end up with like senior people, who haven't been in the trenches for 10 or 15 years, and graduate trainees, they may be very smart and very keen on AI, but it kind of doesn't really work. So the important thing, but it's harder to do in practice than just saying it, is to engage the people with experience, with institutional knowledge and so on like how to deploy AI, how to make it better and all the rest of it. And of course, it's easier to do that if you're in a situation where if people are adaptable, they all have work to do, right? Than one where maybe, you do have too many people.
So you had mentioned digital transformation. So it sounds as if AI is going through some of the same issues that digital transformation had. So then the question then becomes, um, what tools, if you're a C-suite executive, because you said in a lot of cases the boards and the C-suite executives are very keen on adopting. They were keen on digital transformation. Now they're keen on AI. And as you know, from your experience, it's a misnomer to think that a C-suite executive can just order something and it just happens. What are you seeing they're doing when they're successful? What do you think they can do so that they don't have the same fate that they had with digital transformation, and so they can't get AI or even data or some of these other changes that we see available with new data and new technology and tools?
Well, I think if companies had actually done digital transformation properly, then they would be in a much better position to deploy AI, right? And because part of it would be about data and so on, and it would already be kind of sorted out, right? So I think the problem is they only partially did digital transformation, and now they're trying to do AI. So I would say a few things. First of all, it's no good just taking a total mess and saying, oh, we're going to use AI, right? To your point, you need to know what data you have, where is it, like who owns it, what's it being used for, and get it into a decent shape. And by the way, there's another interesting topic that's been raised now because of all this issue about like cyber attacks and the role of AI in that, about having too much data. So I was on an interesting call recently where they were kind of cautioning about if you have personal data or things that you don't need to retain for regulatory purposes and it's old, you probably want to get rid of that, because otherwise it's sitting around, maybe being harvested, maybe in the run up to quantum or this type of thing. That's the kind of thing that boards need to be asking about. But anyway, back to the question. I think ideally, like C-suite have to have a vision, which they have to anyway, right? And then explain how AI fits into that strategy. Not we're just doing AI for the sake of doing AI, or we're not just doing it for like short-term cost saving. Then and be able to communicate that to people kind of throughout the company. So to go to the earlier point, so that somebody can be, okay, I'm going to work to make this model useful for doing such and such a task. I think they have to be transparent. As I say, it's easier in companies that are growing because they're not facing kind of like mass layoffs. But I think being inauthentic or changing the story every 5 minutes, that you don't have trust with the employees, you don't have trust with the board either, for that matter, right? So they need to be kind of like realistic about what's going on, and then really, to me, one of the keys to being successful with AI is, well, get rid of silos, right? We've talked about, claims bill need to speak to underwriters and all the rest of it. That's not new with AI. But you need to have, people in the business, IT, HR, risk, internal audit, all sorts of folks need to be in the room when these things are being discussed, and make sure that, their voices are heard. And then the question to which I don't know the answer is, I think the successful companies of, I was going to say tomorrow, but I don't mean literally tomorrow, but successful companies in 2 to 5 years' time will look different structurally from what they look like today. What are they going to look like? I don't know. And I'm not sure anybody does, right? Because everyone's talking about, well, you need to have a different org chart because, of the way that AI works. But like, what org chart, right? And I mean, people have to somehow have a boss or whatever, right? So this is quite tricky, because there are roles and departments and whatever which maybe will not exist in a few years' time. So I think everyone has to be a bit agile and be okay with a level of uncertainty. So yeah, I think if leadership can kind of, create a vision, make it clear kind of like what people's roles are, what is AI, like what is not AI, why we still need people, then and that we don't know all the answers. I think that helps a lot. I would be most suspicious of anybody, whatever their role is, who says that they know all the answers, because the smarter the people I talk to, the more they admit they don't know the answers.
But you were at Swiss Re, and Swiss Re did transform. And you were in the middle of that when they changed the reporting and the structure work there. What did it take?
Well, it was interesting because Swiss Re actually transformed in two different ways. So they transformed in the financial crisis by necessity. And there were some things that were done very well. There were some things that, with hindsight could have been done better, but, okay. And then it was subsequent to that that they wanted to really change the structure of the company. So what happened was that Swiss Re, the main underwriting company, was also the parent company at the time. And then there were like various subsidiaries doing different things. And the vision of the board was, okay, we want to have a holding company, and then we want to have separate pillars beneath that, which are the ones you referred to earlier, that are going to, report, like have a kind of P&L and balance sheet and report. And the idea being there's more accountability, and also there's more comparability, both for the management themselves, for the board, and for investors with similar companies. Otherwise, you've got this mishmash kind of supermarket, right? That you don't know what's going on. So there were a few issues. First of all, originally, apparently, the board and the chair was told, you can't do this. It's impossible to convert this company structure. No one's ever done it in Switzerland. Well, it turned out that apparently we could. So being able to kind of think and press ahead and so on was important, and get your legal team and your bankers and so on around the table. So that was one hurdle. Then another hurdle was that the company, in most cases, hadn't thought of itself in that way, right? So if you take asset management, the asset management folks were running these big pools of assets, but kind of for the whole company, and they didn't really take any notice of where the money was coming from, which is kind of interesting, because insurance companies, one of the things that's very important, especially if you write longer tail businesses, asset liability matching, right? In terms of duration, also currency, and so on. And, they were doing all this stuff, but it didn't really kind of occur to them that the assets were attributable to a certain area of the business. And would be fair to say that when we came with this plan, they were not extremely thrilled that they would have to basically earmark all these investments, right, for whether it was like reinsurance, property casualty reinsurance, the life and health reinsurance, or for Swiss Re corporate solutions. But they did do it, and they did an excellent job. But it did really require a mindset change, because they just didn't think about it that way. And they were good at doing their jobs. And I'm sure, and I know, they thought, oh, this is a lot of work. Why do we have to do this? But I do believe that for the transparency and, as I say, understanding the business, both internally and externally, it was actually a good thing to do. But and it did come very much from the top. And so, to be fair to the people involved who are retired now, but they might not have loved it, but they absolutely got on board and did do a good job. But there were some expressions of horror early in the process, I have to say. So by the end of this, the company had gone through couple of transformations. One was more about really focusing more on underwriting, not taking as much risk on the asset side, thinking of the company more as really an insurer, as opposed to maybe competing with like investment banks and kind of wider financial services. That was the kind of cultural thing in the financial crisis. And then the second one was more the corporate structure and the external internal reporting. And obviously along with that went, KPIs and all these great things.
Susan Holliday, thank you for joining Structural Signal.
Thank you for having me.
Like and subscribe for our weekly podcast. Read our weekly market intelligence reports on our Substack, structuralsignal.com.